Hey there, Dave Nadig here, financial futurist at Vettafi, out on a beautiful spring morning. Had the opportunity to sit down with Eric Biegeleisen, the Deputy CIO of 3EDGE Asset Management. We had a really good conversation about how they think about money, why they're positioned incredibly conservatively right now, what's going on in the fixed income market. We also dive into things like different modes of getting paid as a financial advisor and different ways of doing business as a financial advisor. I hope you think it's interesting. I certainly did. Cheers. Eric, thanks for taking some time with us today. You guys are a little unique in your current positioning in the models that you've got at 3EDGE. When I asked you to join the fixed income webinar that we're doing at the end of May, you told me that you were happy to, but that your opinion of fixed income was all treasuries and maybe some gold. So I'd love to, let's start with that. It sounds like you guys have particularly bearish positioning right now.
We do. That's right. That's a good way to put it. We've been at or near our minimums in U.S. equities for quite some time, through most of last year and continuing into this year. We find U.S. equities to just be incredibly overvalued by our measure, not particularly favorable economics, as we see an inverted yield curve that's heading more in the more inverted direction, not the steepening direction. These are all bad indicators for future prospects for economic growth. You know, behaviorally, you've had a rise in CPI, which was bad earlier on, although CPI has come down somewhat. It's not necessarily getting to the Fed's expected measure. We have seen unemployment low, but that's potentially going to go up as well soon. We're also seeing jolts come down. In terms of credit or fixed income, like you just mentioned, we haven't had any credit in the portfolio for a few years, and maybe we've left a few basis points on the table by not getting invested in credit, even at the short end. So it's been all a variety, hodgepodge of treasuries, floating rate treasuries, short-term T-bills.
Munis for the right client?
We don't invest in munis. No munis. Some tips, both short and intermediate duration tips. That's really where most of and these are in the core strategies that we run. We always have a minimum allocation in all strategies to gold, but we've found gold more attractive in recent months and have even more recently added a bit more to it.
I've known you for a long time. Yeah. And I think it's fair to say that your basic ethos of looking at sort of all three tranches of time, looking at the long term, looking at the medium term, looking at short term trading and sentiment issues, I know that you've got a quant model that incorporates all of that.
Correct, right.
What would it take in the model for you to all of a sudden say, hey, you know what, investment grade bonds, looking great. You know what, S&P 500, we're back in at a low allocation. What's the turn point for you?
No, it's a great question. There have been some non-U.S. equities that we have found attractive more recently. Q4.
Guessing Europe, right?
China in Q4. More of the beginning of this year was Europe. Yep. These are more tactical, probably shorter term plays, maybe a few months long at most. In terms of U.S., you would need to see a rally of sorts. So a momentum-driven thing could probably get us more attractive. The other way that we might find U.S. equities attractive is if they fall a lot more, if the valuations become more reasonable. I'm not calling for this, but mathematically, the way we measure valuation, particularly for the U.S., we would need to see the U.S. at around 3,000 before we would call it fair value. So that's a bit of a drop from here if it's over 4,000 right now.
Right. How is it working with clients, though? Because as an advisor, as an advisory firm, I think folks expect a level of activity, and you guys have really been out of equities, as you said, for a year or more at this point, or at least on the credit side, on the corporate side. So how does the conversation go with a client who's like, well, but we just missed this rally for a month and a half in X asset?
That's right. Well, and it depends on, it has to do with the education that the client gets before they become a client, right? And so the clients who saw the benefits of downside protection in 2022, as equities and bonds both sold off and our strategies were down just like a tiny bit, they're saying, oh, great job, guys, this is fantastic. And then when we miss a rally, say in Q1 this year, because we're still light in equity, they're saying, most of them are generally speaking okay with it. They're like, hey, this is why I have you in the portfolio. This is what you're there for.
So let's talk a little bit about the internals of what's going on in the fixed income market. What is it about credit that has you spooked enough to not be in it at all? I mean, credit spreads aren't like absolutely minuscule. We've had some rising rates. We've got new issuance coming out. what seemed to be pretty attractive, investment grade coupons.
Yep.
Why do you want nothing to do with it? I mean, you're leaving percents on the table.
I think it's changed. I think that storyline's that narrative's changed over the last couple of years as we've been out, but there's been a concern that spreads are going to blow out in a big way, and they did at some point, 2020, and they come back in. And we're just staying on the sidelines here. So we're saying, hey, did we miss something? But then we're still concerned about the overvaluation. And we think things have to fall so much further, which would likely coincide with spreads widening out. And spreads have widened out recently. You've had the failure of SVB and First Republic.
But there's no point at which that spread is so wide, you're like, well, we got to get us some of that.
Right. Well, that's right. I mean, it's just not, right now, we feel like potentially the probability is that there's another shoe to drop, and so maybe this isn't the best entry point. Maybe it's down the road when and if there is another drawdown. Spreads really gap out. That maybe
now
is the
all of a sudden you're getting 8% on IG or something like that.
And why take the credit risk when you can now get a decent yield on the risk-free rate?
Yeah, and I guess to some extent, how much do we believe the default rate story anyway? Because we haven't really seen the rash of default. I mean, all through the pandemic, there was this narrative that's like energy producers and all those guys are going to default on their junk debt. Didn't really happen, right? I mean, for the most part, the corporate space has been really solid.
Hasn't yet.
Okay, so you think there's that shoe to drop.
I think there's a tremendous amount of corporate debt in the system, and the maturity walls are further out, right? I mean, high yield sooner than IG. There's been an aggressive move by the Fed, unprecedented in terms of the number and steepness of rate hikes that they did last year. And it's not clear that lag has caught up. And so the fear is, if the Fed does hold rates higher for longer, more and more of these companies have to recycle their debt, which they were paying almost nothing on, and now they have to pay 5, 7, 8, whatever.
The Fed has this problem too, right?
For sure. And so that there's a concern there that this could come real quickly, right? Also, I don't think we're necessarily out of the woods on the regional bank situation. I don't know that it's clear that everything's been taken care of and we're off to the races again.
It seems like what's left is sort of really just basic asset liability mismatch. And it seems like it doesn't feel to me like there's a giant shoebox full of doom that we're just like, oh my God, we had no idea. Right? It's not like the global financial crisis where all of a sudden we were teasing apart derivative structures and finding all these hidden risks. This seems very well understood.
But it does seem like the chance for panic is higher now, particularly with all the social media.
Speed of action.
Just speed of action. Hey, PacWest. Hey, KeyBank. You name the whichever bank you want, and suddenly depositors are gone. They're going to the big four banks, making them even bigger, too large to fail.
Does that make you interested in their credits?
Maybe there should be an ETF of that. Too large to fail.
Too large to fail. I mean, essentially that's what Big B, the Round Hill Fund, has become, right? I mean, it's the 5 big banks, right?
Yep.
And that's sort of like the US version of Toronto Dominion and BMO and stuff. Do you think that there's a world where we end up with that kind of banking oligopoly, and all of a sudden that debt starts looking really interesting because never going to go.
They can't go on it, right? That's interesting. That's an interesting proposition for sure. But
you're not a big buyer. I can tell from the look on your face.
Not just yet.
Not just now.
We're getting there. We're just not there yet.
Yeah, I mean, it seems like we must be heading for a regulatory shift in banking. We must be heading to like a Dodd-Frank 3.0 or something.
You'd imagine, right? Which generally people probably won't be particularly favorable on.
Yeah, I mean, it's going to end up. It doesn't seem like there's a path that doesn't involve further codifying too big to fail. Right. Like that systemically important is going to effectively mean nationalized very 100%. Quickly.
I think that's right.
How are you thinking about this bubble of the debt crisis? Are you looking past it? Are you trying to game it in the intermediate? I know that you guys, you will do things on the short term. You are generally long-term positions.
That's right.
How do you think about this event that's happening in credit at some point this summer?
That's right. Yeah, so we have spent a lot of time talking about the debt ceiling debate that's going on in Washington. Certainly concerned. I think we can see on the 1-year CDS, which is higher than, I think, Colombian government debt CDS now. There's concerns out there. How bad would things be if the U.S. defaults on its debt? I can't probably say. I think it would be awful.
It would be hand grenade for sure.
It would hit everything. Yeah. So this isn't just a Treasury issue, right? This would be a really bad issue. But to the degree, so we're already we have just a low level of equity, so that's good. We hold gold, which maybe would benefit as a haven asset in these times. And then in terms of the shorter term fixed income that we hold, we went through an effort to ensure that we have no no bonds maturing in this like June, say, call it June to September of this year window. If for some reason a default does happen and it's on some T-bill, you just don't want to be the guy holding that
Not
that
a story
T-bill.
you want to tell at a cocktail party later.
Right. Like, we were those guys. Yeah. So we pushed ahead, any form of short-term maturity to be beyond.
Shouldn't have gone all in on AT1 debt or Credit Suisse or whatever, right? There are people out there who are the bag holders on those things.
Yes.
And I get what you're saying. You don't ever want to be the one who's got that on the client's statement. I mean,
maybe
wouldn't
we
that
don't want to hold
create
that.
an incredible buying opportunity? Because everybody says what you're saying, which is, we're not going to hold this bill window where there's a potential to get caught in the, even a delayed coupon payment or something like that. Don't want to touch it. Isn't all that stuff going to just start throwing off 15%
I think you're right. I think that would be the time to move back. Could be interesting, yeah. I mean, I think there's a number of people who have to, corporations.
Yeah, of course.
That's going to exist. But for firms like ours, we've been holding such short-term 0 to 3 month T-bills. We just rolled that out a bit, 6 months to a year or longer, where the yields, quite frankly, are a little juicier anyhow.
So what's your positioning right now on the inflation story? I mean, you mentioned that you guys do use tips, which, my old adage is by the time we're talking about tips, you're probably too late. You should have bought them before.
Yeah, so we like tips. We like the shorter term tips in particular. But, real interest rates in 2022, I believe it was, started the year at minus 110, ended the year at maybe plus 110 or 150, something like that. It was a huge move, right, up, which wasn't particularly great for tips, actually.
Right.
But tips now are generating a positive real return, so that's attractive. Though it could be that that's peaked and that's likely to come back down, particularly if we're heading into a slowdown or an economic recession. You would expect probably those real yields to drop. That'll be a good thing for tips and presumably a good thing for gold as well, all at the same time. So we're favorable on that.
So talk to me a little bit about your commitment to gold. I mean, are you approaching that from the position of, hey, it's a historical real asset, it's been a diversifier in times that matter, we're keeping it that way, or is it more of a true like guns and butter apocalypse type play?
All of the above. Yes. So we always have a small allocation to gold across all portfolios, and it's kind of for what you said. I mean, we believe in having some equity, some intermediate duration fixed income, some gold, some cash at all times to weather economic uncertainties, model uncertainties, et cetera. Over and above that, that's going to be more tactical. The model's going to be kind of giving us that indication to say, hey, now it might be a good time to hold more gold. And that has, over the past several months, that has certainly been the case.
Is it mostly momentum in that case? Because, I mean, gold sort of started picking up
so
a bit.
Momentum's a piece of that. We do have a couple of momentum and acceleration factors. We have a nonlinear momentum that we call breakout momentum, whereby it's largely an unimportant, non-involved factor. But when and if you break out to the upside, we have a similar one on the downside, that's likely to attract more capital. So when you're breaking out to a high that hasn't been seen ever, or a high that hasn't been seen in a long time, like we've just passed around 2040-ish, that's going to likely attract more capital, that on its own right. Then you have factors looking at real yields, like I just talked about, not only the absolute level of real yield, but the rate of change of that real yield. And if we're seeing that slowly tick down, that's going to be a positive for gold as well. So those are, making gold look a little more attractive.
And are you choosing to get that exposure sort of through fairly traditional ETF type means, or are you like actually doing allocated bullion and vaults for individual clients and that kind of stuff?
We used to do that pre-ETF.
Okay.
That was a long time ago. Yes, we use ETFs. So we'll look for low cost, high liquidity type products. We have ESG solutions where we'll use more sustainable gold products. In products where we have an all equity product solution where we wouldn't necessarily put gold in it, but we might use gold miners.
Right.
So things like that to get those exposures.
What does the all equity portfolio look like right now? What are its tilts?
It's fairly defensive, right? It's mandated to be
it's
mandated to be always invested in equity. But then we have our main model over here, the big macro model saying get out of equity. You don't want to be in stuff.
Right.
So it is definitely heavier in Europe because that's the one area of the world we find somewhat attractive still. And then generally speaking, the U.S., Japan, China, India, we're at somewhat the minimums that it can hold, and to the degree we have to hold there, we may use defensive holdings like buffered ETFs. So you're still invested, but you're getting a low beta to it. And then we'll even in many cases, we'll have outlooks on different currencies as well, and so we can further hedge the exposure. Say if we don't want the yen or the euro, that sort of thing to help again, those have been good, additive ETFs in the universe to help a strategy like this.
You brought up currency, so now we got to go into it. So, one of the other big Twitter debates these days is the dollar just going into endless decline and failure as reserve currency?
I have no reason to believe the dollar is in any way, shape, or form anytime soon losing its reserve status. I mean, any chart you can look at
So that's not why you're holding gold. You're not holding gold because you think you're going to be literally buying groceries.
No. I mean, I think it's the U.S. is not the only profligate government, printing at will.
Right.
So, but
we've been learning everything we can from Japan for a while.
So, I mean, everything's still settling in U.S., Euro, Japan, a little bit renminbi, right? This is not changing anytime soon. I don't think. Right. What's going on with Russian oil and this and that. I don't think India is going to cozy up to China all of a sudden. But I think over the long term, you're going to see, we're going to have elevated inflation. You're going to see continued decline of the value of the dollar in terms of things priced in dollars. So that's why over the long term, gold, commodities, Bitcoin, crypto, things priced in dollars are going to, in theory, benefit from the continued, devaluation.
But now you brought up Bitcoin. First time, literally like 14
How far
minutes in.
How did we?
14 minutes in. I'm going to guess, since you haven't mentioned it yet, it's not a place you guys are making big allocations. Is it something that you talk to clients about? Has it come up?
Absolutely. So we do run a tactical crypto strategy, also in an SMA like everything else, and we'll use the different 40 Act products that are available. Many of them have their own issues, given that you can't have a spot crypto ETF yet at this point. But we do keep that separate and distinct from our other strategies.
It's like core model. How do you think about regulatory involvement in your space? You have billions of dollars on the line.
For sure. Specifically with regard to crypto or wherever.
In general,
wherever,
you have to deal with the regulators in a whole bunch of different directions.
Correct. With regard to our business, less about crypto, I know an area that the most recent rule that came out changed the marketing rule, right?
Yeah.
And so that's impacted things. We used to do this is small, but you used to calculate your composite for all the accounts you manage, and you would weighted average fee would be applied, which seems like a reasonable approach, and then you'd show that as your net composite number.
The average dollar gets charged X.
Yeah, right. But now the SEC is saying, the marketing rule is saying, that's not fair, because if you have a tiered fee schedule, for example, then someone who comes in at the highest fee is actually not going to get that net composite number. That's a blended average of all the fees that your clients pay. So now everyone pays. Now you just make a net composite that has the worst case fee. And we're seeing that on some of the TAMP platforms, the third-party asset manager platforms. They're imposing much more steep fees. That's like the worst case that an end client could have to pay, with all the different mouths to feed along the way.
And all of a sudden it looks terrible. But that's been a challenge of the financial advice business for ages.
For sure.
That the reality is, if you show up with 50 grand, you're going to pay a very high percentage fee for somebody to pay attention to you. If you show up with 50 million, you're going to pay a much lower percentage fee, but objectively a lot more actual dollars.
Correct.
And that's the weird thing about financial advice, is we have this scaling fee structure that's sort of baked in from fund companies on down.
Yeah.
And yet it's very rare that the actual allocation of labor perfectly matches those fees that are collected.
Yeah.
How do you think about that when you're dealing with clients? I mean, you're in the business of growing assets like every advisor out there. Obviously, $100 million client is very different than $1 million client. So how do you think about those differently?
Yeah, it depends on the medium through which we get these clients as well. That changes the fee schedule as well, right? And it really comes down to how much work and effort is it to service that client and make sure that they have a great experience, right? Are we trading the account first off, or is it through a TAMP?
And at that point, you don't really have a direct relationship with any of those customers. They're consumers of your intellectual property.
Correct.
Right?
But you do have a relationship with the advisor, right? That sits in between, who's selecting you on some
Right. They become
platform.
your client.
Correct. And that's great. That's very scalable. It's easier to have that conversation with one advisor who's then servicing 20 or 100 clients, for sure. And which is why it's a much smaller amount of revenue that we get for it.
Right.
But then if you're doing, say, contrast that to a directly managed SMA account, where we're trading it, we're dealing with the client, that $50,000 account might require just as much time, in some cases even more, than that $10 million account.
But there's a real reluctance for most of the industry to go to a pure sort of nearly hourly kind of fee for service model, because that seems to...
I think that's interesting.
I think that's a tough one to judge. I mean, I know guys like Rick Ferry, very much on board. Like, you pay me a couple $100 an hour, that's what you pay me, which I admire. Like, I understand the intellectual purity of it, but the reality is it's very tough to run a business that way when, you know, your $1 billion client books you for 15 hours of hard work and then you don't see them for a year and a half.
Right. I mean, the thing is too, we're not just set it and forget it, right?
Exactly.
So maybe we're not talking to our clients every day, but we are watching their money every day.
It's not like you have jobs.
Yes.
That's what you're saying.
And we're trying to avoid drawdowns. We're trying to put them in the assets we think are going to perform well, get them out of the ones that won't perform well. So I think, you know, we should be compensated for doing something.
I'm not arguing against that. I'm just saying that seems to be this weird fundamental tension, which is, you know, folks who are providing what I would consider more fundamental financial advice.
Yeah, I think that's right. And we've been really most of our business very focused on asset management piece, right? And only doing very light financial planning.
It feels like what you're describing is something we've seen in the industry, which is the sort of bifurcation of the kind of advisor you are, right? Whether you work for Schwab or you hang out your own shingle, you know, or your own large RIA like you guys are, there are folks out there who are fundamentally asset managers, and they don't really want to deal with the big, giant, hairy family office stuff on the day-to-day. And then you've got other folks who are like, I don't run money, I run families.
Right.
And they need people like you to help run the money.
Exactly.
That seems like it's gotten even more entrenched over the last decade.
I think you're right. Yeah, I think that we're seeing that too. I mean, we're getting more and more desire from clients for some financial planning. And I think, you know, to some degree we can do some of that, but I'd also suggest, you know, for the really deep, detailed multi-trusts, you know, you need legal getting involved. You're gonna need a different service for that, right? And we don't want to. We want to stick to what we're good at, what we think we're good at, I should say.
I think the tricky bit is knowing which one you are. When I talk to some younger financial advisors, you know, guys in their 20s and 30s who are just getting started in this business, a lot of times they think they will do everything. I'm going to be the best financial planner. I'm going to do a mini family office, and I'm doing all the asset allocation. And by the way, I'm running the options overlay. Right? And that's where I get a little scared. Not because I don't think that there are people out there who can and do that very well as one-man bands, but I think it's rare.
You know, growing a business makes more sense to do the stuff that we don't do, the more wealth management piece, if you will, the hand-holding, the help, because that's this business, I think, regardless of what happens with AI and what have you, or model delivery, like humans want humans, right? You need to have trust in this business. That's not going to go away. You worked your butt off your whole life, you saved up all this money, you don't want to lose it, you want to grow it. You need a human being on the other side of that, I think. And I don't think that's going to go away. Maybe when you're younger and you have a smaller amount of money, you can trust, you know, some bot to manage your money. I just don't think as you age, people are going to want that.
I think people have questions and they want to know who's giving them the answers.
Yeah.
Right? I think that's a big difference. Well, this has been a lot of fun. Thanks, Eric.
Oh, thank you.